Welcome to the Doe Show, everybody. Happy Tuesday. Hope you're having a great day so far. This is the Doe Show. If you've never watched us before here, my name is Dustin Tibbetts, financial advisor with Jazz Wealth Managers. Lots more big things to come. But if you've never seen this show before, this is where we talk about your dough. How can we get your dough straight? You're getting the information from a financial advisor, registered financial advisor, SEC registered financial advisor, fiduciary financial advisor, and we manage our own portfolios. So we don't play any games here. We get to actually invest for you the way is best for you without any conflict of interest. Well, today we're talking about four investing mistakes that you can actually avoid, right? That you can avoid it, but your emotions may not let you. I'm actually going through a couple customers right now trying to help them through some of these mistakes, and it's kind of what inspired the video. So we will get started. Hopefully we will not take too much of your time. When it comes to investing, look, hey, the game's hard enough, right? I mean, it's hard enough to figure out how much you should invest, how you should invest it, how often you should be investing. Is that going to be enough for your goal? Is the person that's helping you doing a good enough job? It's already hard enough. So if we have to mix in additional mistakes here that cost you time, we can't get time back, right? So I always say cash is not king, time is king when it comes to retirement investing, because if we get you 30 years down the road, and you don't have enough money for retirement, you can't go back and try it again, right? If you buy a brand new car and you finance it for 15 years or something ridiculous, and you get 5 years down the road and you go, well, crap, that's not gonna work. At least you can change. You can sort of, take your lumps, if you will, and you can work your way out of it. When it comes to retirement investing, you don't know, right? You get to the end and you're like, did I make it? Right? I don't know. So you got to make sure you don't make a few of these mistakes. And the first one is really, really simple. We're going to write them down because I feel like writing today. The first one is the bandwagon mistake. Oops. Or writing. How many times you jumped on one of those bandwagons, right? You know what a bandwagon actually is? I don't. But what the idea behind it is what are some of the most exciting things? Pot stocks right now. That's a bandwagon trade. You can certainly invest a little bit there, but if you're one of those guys that's posting on Facebook, going nonstop, going, I'm all in, man, pot stocks are the future, okay, you're on the bandwagon trade, right? Cryptocurrencies, that's a bandwagon trade. You can certainly invest a little bit over there, take a shot and see what happens. FANG stocks, your Facebook, Apple, Amazon, Google, Netflix, right? Those were bandwagon trades, and now they've even changed the acronym to MAN, M-A-N-N or something like that. It's another way to just keep your attention on a select area of the market and distract you from what you really need to do. It goes all the way back, by the way. I'm not just talking about now. House flipping, how many of you guys fell into that, right? The old house flipping craze back there, 08, right before the whole crash thing. You bought a house that went up 700% in a couple days, you sold it, and you didn't even fix a single thing, right? Bandwagon. Right? So you got to avoid that. .com stocks. How many of you go back to the 2000s, right? How many of you go back to that? Do you remember this phrase? If you remember this phrase, you go back that far. Click and mortar. That just shows my age, right? So like the hair, you got like a little bit, right? It's starting to like peek its way back in there. God forbid the thing that's going on here shows my age. But maybe a little bit of this still looks pretty young, or the fact that I got this little guy down here, maybe that helps me look younger. Some of you don't think I go back that far, but we used to call it click and mortar. That was the whole craze at that time. Instead of brick and mortar, everybody was going click and mortar, and that was going to be the future, and you had to dive into it, and you had to get yourself some pets.com. You had to get yourself all of those different stocks that ultimately turned out to be nothing, right? How many of you remember Heelys? Right? I would buy those. I would totally buy those if I could find one in my size that didn't look horrible. Heelys with the little ball wheel that came out of the shoe. You know that was a public company. In its first day when it went IPO, it gained 60% in its first day as a public company. They sold shoes with wheels inside of them. They were a public company. They are not no more. It was a craze. It was a fad. Crocs is another shoe example. I don't know why I'm on the shoes today. Crocs. Everybody went crazy for these rubber shoes. Come to find out, they're not good for you. And they had to retool and re-advance and everything. And so all of this goes all the way back to the great tulip mania, right? None of us were around for that one, but if you are a historian, if you're interested in studying the stock market, look up the great tulip mania, the first craze, the first bandwagon trade ever in history, the great tulip mania. You laugh at it now, but in reality, we're just repeating the same thing. And you know what? After this pot stock thing is over, there's going to be another one. There's going to be something else. Cobalt, right? That's always getting a little attention there. There'll be something else that everybody focuses on there. So the bandwagon trades, you got to avoid that, man. Number 2, I don't like this one anymore. Number 2, the mistake of volatility. I'm just going to do this real quick here. We're going to go volatility versus risk. Now that's a little geeky term for me. I mean, that's could be said a little more simpler. It could be said easier, but the idea here is, what volatility are you expecting versus the risk you're taking, right? So let's dig into this one a little bit. There's a term called beta, right? Maybe you've seen this one. Have you seen the word beta when it comes to individual stocks, the stock market, whatever it may be? They say, well, beta is a measure of risk. Not exactly, right? So everybody likes to look at beta and they go, well, that's your level of risk that you have there. Actually, beta measures the volatility of an individual product, in the case of investing. It measures the volatility of an individual product relative to a benchmark, most commonly the S&P 500. And so what it's telling you is, if the stock market moves like this, right, and is got a decent sort of flow to it, what it's telling you is that the flow of your stock may be like this, right? And that's probably the easiest way I can draw it. The market's wiggling around at a certain pace, right? And or certain volatility. And it's like you throw something in the water, right? See how I made the water? It's nice and fluffy. And then all of a sudden you do a cannonball into the water, and you have a bigger wave. So if you were to think of stocks, you've got the market moving around like this ever so slowly or at whatever pace, and your stock is wiggling around more than that. It's the measure of how active your stock is relative to a benchmark, most commonly the S&P 500. So beta really doesn't dig into risk. Well, a lot of people will buy stocks based on something they heard, something they're interested in, and they don't understand the volatility of that individual name. And guess what happens? Square is a great example. Amazon's a great example. Netflix is a great example. Tilray is a great example of stocks that people invest in. It falls 6%. Look at what happened to Amazon yesterday. It's just a 6% drop, maybe not so scary. But when you're looking at many tens of dollars, what was it, $32 that it fell? People go, holy crap, something must be wrong with my stock, and they panic. Well, in reality, that was totally normal and well within range, actually just a touch outside of range if you're going to talk about Amazon, but basically within range of what that stock is capable of doing relative to the stock market. So really, you want to make sure your volatility of your individual stock, your individual holdings, or your portfolio as a whole is relative to the risk you're comfortable with, right? So if you own a bunch of Amazons or a bunch of Netflix, or let's just say you owned all 3 of those stocks, Amazon, Netflix, and Tilray, you happen to have a nice little mix there, you are going to see much more fluctuation in those in your portfolio, given those 3 names, relative to the stock market. Your portfolio will do this, and the market's just going to be wiggling around. Well, what happens when the stock market gets a little crazy and does that? Your portfolio is going to go friggin' crazy. And if you don't know that ahead of time, you're liable to make the risk of saying, oh no, let me close these positions. Something must be wrong. These positions moved greater than I was hoping for. In reality, it may be perfectly normal that these stocks are wiggling around in the way that they are. If you were to pick Verizon, if you were to pick Ford, right? Here you've got the stock market doing this, and if you were to pick some of those slower movers, those AT&Ts, you'd actually be seeing this, right? So if we were to measure the length and the volatility of them, not a big deal, right? So in the event that the stock market had, like it kind of did yesterday, a bigger decline, yeah, you would notice a little bit more here than expected, but not as much as the market, and therefore you probably wouldn't panic, right? Or at least if you understood that, then you wouldn't panic ahead of time, okay? So, big mistake that you can't avoid just by simply understanding. Look it up. Look up, if you own a stock, look up the beta of that stock relative to whatever you're wanting to do it. If it's an Amazon, look it up relative to the NASDAQ. If it's a Verizon, look it up relative to the S&P 500. You could do however you like there, but at least understand your volatility versus your risk. Okay, that one was a little bit geeky there. Let's move on to number 3. You've got this high watermark mentality. Yeah. That's me. That's my handwriting. Now, if you're one of our customers and you got the towel in the mail and you see the handwriting on there, you know I didn't send it. It would get sent back. I don't have very good handwriting. The high water mentality. Okay, here's what happens. This is psychological, right? And trading is a lot about having a plan and then psychologically being able to execute on that plan. Okay, right now, here's what we're going with a couple customers. They have outside accounts. They've invested in some products. Those products, where's Kai? Kai, talk to me. He wants me to talk about this. So they invested in something, fell more than they were hoping it would fall. And they said, Dustin, what should I do about this stock? And I said, well, what's the number you're going to get out if it keeps falling? What's the number you're going to get out when it recovers and bounces? And I didn't get an answer, right? So a lot of these customers are going, I don't know, it's a long-term position for me. When it bounces, I will just get out. And I go, okay, but psychologically think about that. When it bounces, your fear is going to be eliminated, and now you're going to get greedy again and go, how high will it go? Well, look, it went to this high before, so it must go back to that high again. Many people fall for that trap. The stock market has fallen from its highs. No doubt about it, no way to ignore it. We are all experiencing pullbacks in our long-term investments. However, the market does not need to bounce back to those highs right now. The stock market could just simply bounce back a little bit. Here's a fun stat for you. I tweeted this one out earlier at JazzWealth on Twitter. Since 1952, we are in the last 2 days of the stock market for the month. Whenever the S&P 500 sold off 8% or more and still had 2 days left until the end of the month, it rallied an average of 2.75% in the last 2 days. And it did that 80% of the time. Did I just geek you out or what? Like, is that like, what are we doing? So follow stats, right? You want to know the statistics of when something may go back to a high watermark, but I don't want you falling for the idea that I bought a stock here, it fell here, and when it recovers, it will go back to this high. That is not the case, okay? Do not fall for that. People see that all the time and they expect things like that to happen. Look at the housing trend, 2006 to 2008, all in that. You thought that housing prices were going to continue a trend, a high watermark trend that really wasn't going to happen, right? Eventually it had to take a break. The stock market is currently trending. It will take a break. It will relax. It'll be no big. Look at Amazon. Amazon's been on fire, doing great, no problem. Back to the housing thing real quick. I had a high school economics teacher tell us as the students that home prices in our area do not go down. And therefore, if some of you do not make it in the real world and you want to buy a house, go ahead and do it as soon as possible because the values will only go up. I remember him teaching us that, and my mind as a little teenager was like, come on, right? Well, like, why wouldn't everybody do that then? Of course, let's go buy a house. And I thought that was the worst advice I was ever given in high school, because if you look at it now, since I've been out of high school, 15% is the total gain in this area for houses. They did lose value. They, of course, got hit with the whole crash and all that stuff, you know, whatever. So the idea that a trend will continue, that teacher fell for that. They thought that things would just keep going and it would be perfectly fine. Yeah, little pullbacks along the way. No, in reality, you can have many long drawdowns. The stock market can hit a high watermark and then just float back lower for years and years, then recover. So you got to be prepared for that, okay? All right, lastly, I guess we're using red again. Lastly, number 4, your failure to compare your choices versus your options. So don't fail to compare. All right? Now, I'm not talking about investments, right? Or like individual stocks. Should I buy Square? Should I buy PayPal? Should I buy Netflix? Should I buy Amazon? I'm talking about comparing what you set out to do. If you have a long-term plan to invest in a Roth IRA or your 401k or whatever, you need to compare your choices. Take 5 minutes, 10 minutes, whatever it takes. Go in your 401k and compare everything you have. Don't just dive into the target date fund. It may be the best choice for you, but at least take a minute and look through the rest of them. I want you to compare, and God, this happens so much. Please do me a favor. If you are going to open an IRA, a Roth IRA, or some other retirement account, don't go to your bank, right? Like, I don't care where you go. I hope you choose us or at least give us a shot, but don't go to your bank. Go anywhere else besides your bank. Because if you can't, you got to compare what the bank is going to do for you versus what maybe Jazz will do for you here or some other advisor. A bank will invest you in the most conservative products possible. I can't tell you how many accounts I transfer of 20-somethings from banks. Then they've made 0.5% all these years. They did the right thing. They got started early, but they only made 0.5%, maybe 2% at most because they were in conservative investments. Banks are not bad people. However, they invest conservatively because they want you to see a stable, safe environment where your money is good in the checking account, your money is safe in retirement. And so they use very, very safe investments, especially the regional banks and such, because they can't afford to have these liabilities. Whereas an advisor, someone like us, we're going to look at you and go, you're 25, you need to be aggressive. Swing for the fences. It's going to hurt sometimes, and I know you're going to wake up and see the markets like, oh my God, what's going on? But you're going to be just fine. So make sure you compare that when you're kind of doing that. Now, when you look at that, compare the investments. What is someone like Jazz going to use and what is someone like another advisor going to use? We charge to manage the account, give you financial advice, help you along the way, teach you as much as possible, give you nest egg. I promise you there's nobody that's going to work harder than us. However, we don't invest you in things that cost you money. That's a big one. Other advisors, they'll say, yeah, we're going to charge you to manage your account. Then they're just going to go buy a mutual fund that costs you money, right? So compare in those sort of options. Open your eyes. It's okay if you find that this guy's cheaper than this guy or something like that, but at least you dug in there and you looked and you won't get taken advantage of. I can't tell you how often I see people, they go, hey, I opened an account at this place, and if you've opened an account, you'll know where I'm talking about. I open an account over here, and every time I make a deposit, it's 5% just to make a deposit. The company charges 5% simply to put money in your IRA. So compare that company with any other advisor on the planet. I'm not saying we're better. We won't charge you to make a deposit. But that company is like the only company that I know that charges people to put money into their account. Compare those costs, okay? So it's okay if you look at us and you go, I'm going to do it myself, or maybe it's cheaper if I do it myself. I have no problem with that. I will never suggest that everybody should come to us. But number one, stay away from the bandwagon trades. I only know this is a problem right now because of all the emails I'm getting. I love them, but you guys are all in the same boat. Like it or not, when you email me and go, Dustin, I own this stock, and what do I do? I've already answered it 50 times for the night because everybody's in the same bandwagon. Stop it. Go find investments that you like that nobody's talking about right now so that when they become popular, healthcare, great example, so when they become popular, all of a sudden you're on the bandwagon and have something to sell to all the people that want to buy. Number two, understand the volatility that you have in whatever group of stocks or portfolio you build relative to the risk you're taking, okay? Understand how it works. That way, when you wake up and you see, well, the market had a bad day, or the market's had a bad couple weeks, and you're participating in that, you go, okay, that's understandable, right? I don't need the money anyways. I'd actually like to buy a little bit more, but I understand my volatility in my portfolio relative to my risk, my ultimate goal, what I'm trying to do. Very nice. Number three, high watermark. Don't expect that a trend, what's happening, will always continue. There has to be little breaks along the way. People have to take breaks. I'll use the example of running up a hill. You can run up a hill for a while, Eventually you're going to stop, get some water, you're going to like kind of hunch over a little bit, take a break, and then you can run some more. Stock market's going to do the same thing. It does it through its entire history. Sometimes it runs up a steep hill and needs to take a longer break. Other times it runs up a long, slow, boring hill, which you could run up forever, but at some point it will take a break. And number 4, I want you to compare. Compare what choices you have relative to the outside world, wherever you're at, whatever it may be. If you have questions, I am happy to help at jazzwealth.com. You can just click Chat with Jazz up at the top. For now, we're going to continue doing that, and happy to help there. You can also just leave us a message if you like. All right, wow, a lot of questions there. Your mortgage is higher mostly because of your poor understanding lending in PMI. London, check out your loan to equity at the moment. Home prices have gone up a little bit. Because things have gone well, you might be able to take a look and see if you're now under that 80% threshold. Maybe they'll wipe it out. It's worth looking into it. If you just bought your house, okay, not much you could do there if you didn't put anything down. But a lot of people are finding out that their homes have appreciated, just stuff you've owned for a year. I see now you said 2 years. But a lot of people are finding out, hey, that PMI, I can get rid of that. It's been 10 years, it's been 9 years, whatever it's been. I can now call and say, hey, I would like to use one of your lender-approved appraisers. That's the key there. Wow, separate lesson today, guys, huh? Totally separate lesson. Call your lender, say, I'd like to know your lender-approved appraisers. Get one of them to come do the appraisal for your house. If you come in under value, you submit it back to them, wipe out the PMI just like that, simply because time has passed. Something about taxes. I won't get into that, but all right. You used to own Bank of America, now you own Wells Fargo. Okay, a lot of them are beaten down. The banking stocks actually quite discounted these days. Morgan Stanley, JP Morgan's your strongest in the group, I believe, as of now, at least of the big banks. Can Jazz Wealth provide better income generating opportunities than Nationwide Run 457? I don't know, what's inside of that. I would say that anything we would offer is right on our website as far as our funds and everything. We have a great growth and income mix where we mix those different funds together. And then, of course, we have a great dividend fund. Our dividend fund, our REIT fund, I would talk pretty highly about. And I'm not like a brag kind of guy, but over 3.5% just on our dividend fund alone. And we're about to adjust that so it even gets a little bit better. Just because of what the market's paying. It's not like we're heroes or something. It's just how we're doing. Robert, thanks for watching. Thanks for the comments. I appreciate it. Yep. Can you initiate account with Jazz Wealth using your spousal annuity? Your spousal annuity. There would probably be no need. I wouldn't talk you out of that. That would probably be fairly costly. How long do you think the correction is going to last? Well, here's the stats, right? So when there's 2 days left to go, the markets tend to rally 2.75% in those last 2 days when a stock market's fallen 8%. Can I go with you for a second? You guys got a minute? Here's the actual statistic, right? So you know how we go by numbers here. When a stock market, the S&P 500, has fallen 8%, and there are 2 days left in the month, right? Only because, we have 2 days left in the month, so that's what we do. So if you got 8% decline, 2 days left in the month, the average rally is 2.75% in those last 2 days. And it happens 80% right on the dot of the time. Kind of want to see what happens, right? So we have fallen more than 8%. There are 2 days left to go. We're looking for 2.75%. Looks like we're getting some of that today, actually. And 80% of the time that's going to happen. Let's see what happens tomorrow. How cool would that be? So that's the stat there. I actually think that we're going to get taken into the end of the year. We will find a low here and start to see a little bit of a rally, but not back to highs. I don't think we go flying right back to highs. I would love to be wrong, but I don't think we go flying back to the all-time highs. Can't make stock suggestions. I wish I could. Can't make individual stock suggestions, only to clients. So if you guys know, every Thursday we do a class just for customers, and if they have questions about individual stocks, I can talk openly and freely about those. But I can't do it on the public deal here. The SEC, we are SEC registered. That's no joke. The letter's right over there, actually. That's behind the towel at the moment. But I just can't. They'll yell at me, I'll get in trouble, then I'll have to stop, and I don't want to stop. I like doing what I do. Robert, we do get asked about hourly advisory services every once in a while. Just haven't done it. I don't know. I don't have a good answer. Anyways, oh, thank you so much, man. I appreciate it, London. I love it. I love it. Perfect. No, really cool. Hey, anyways, we'll be back at 5 o'clock to do the stock market update. Hopefully things hold up in here as the way they are. If you're following the stock market today, we do. We watch every single minute. And did I mention big things are coming? Maybe not right away, but oh man, the stuff we're working on. I'm so excited. Anyways, we'll see you guys later.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.